Good day. Welcome to another episode of Analyst Insights, your plug for everything investments, economics, and finance. I'm your host, Rufaro, and I'm joined today by my colleague, Ranga. Ranga, over the last week, there's been a lot of buzz around the SDRs. They're officially here. Perhaps you can take us through what this means for us from a macroeconomic perspective and from the perspective of our capital markets.
All right. Thanks so much, Rufaro, and thanks for having me. So the SDRs, the special drawing rights, is some financial resource that's being availed by the International Monetary Fund to all the countries to try and inject some liquidity into their economies, to try and provide some impetus after the COVID pandemic actually decimated most of the economic capacity of these countries. So Zimbabwe, being one of the IMF members, is also receiving that money. We are being told that we are receiving just under $1 billion into this economy. So this is probably a big shot on the arm for our economy. It's quite substantial given the size of our economy and also our foreign currency needs. So generally it's understandable to see this kind of buzz and excitement, but already there are questions in terms of how that windfall can be applied and to what extent it can be useful in trying and maybe alleviate some of the economic challenges that we have, especially around foreign currency availability and the need to be funding imports, and also just to make sure that we have enough foreign currency in the economy. So from that point of view, it's positive. I think the biggest challenge, like I've just said, is on the how that those funds are going to be applied. So theoretically, if they are applied well, given what the indications we are getting so far, which is to try and fund productive sectors of the economy and stabilize the currency, one would say it's some positive. It will have some positive effect, but we know that maybe sometimes things don't always pan out the way they are planned to be. And when you look at Zimbabwe, the problem has not been about shortage of foreign currency per se, because this economy actually generates quite some substantial amounts of foreign currency. Just in the last 6 months, I think about 3 billion was generated from exports, and then another billion, or just under $1 billion from about 700 million rather from the diaspora remittances and also some NGO grants. So we are already generating enough. So it means if you try and extrapolate to the end of the year, we could see our exports receipts in the regions of around 5 billion to 6 billion, and maybe diaspora remittances at $1 billion something. So that's about 6-7 billion that we are generating already. So it's not so much about whether we were generating enough. It's probably something to do with how the allocation mechanism and also the level of confidence or lack thereof in the economy around our currency. So as long as the general public has got no confidence in the Zim dollar, I don't think there's an amount of US dollar that could possibly make us feel more comfortable. But yeah, look, as they say, I mean, we all waiting to see how these funds are going to be applied. On the face of it, is a positive development there.
So there's a saying in investment banking that the market is always right. Mm-hmm. And you'd think that given the size of our economy, if it's in the public domain that there's an injection of almost $1 billion, that would have an impact in the way people trade on the parallel market. Mm-hmm. But we haven't seen any change or pullback in the rates there. In other markets, for example, in Zambia, when the SDRs were announced, the kwacha actually strengthened on the basis of anticipation of this significant injection of hard currency. So what is the market telling us, by not being moved by this announcement, by not anticipating this money coming in any meaningful way? What is the market telling us?
So there's a school of thought which seems to be saying maybe the market is slow in reacting because the market as we know it is probably driven by some guy or guys in some dingy place just quoting rates. Back in the day, it used to be at the road port and some other areas where currency was being traded. And I saw someone saying that maybe these guys are not alive to this fact, but I don't think it's correct. There's no one who can be trading at that kind of level who is not plugged in and has got a better understanding of how things are happening around us. But I think there's also another school of thought which says maybe what we are seeing already just tells you that inflow is already imputed into the prices right now. Otherwise, the rate could have been 200. I think it's been a long time people trying to project where the rate is, and quite a number of people were expecting a rate to be much higher than where it is right now. So probably one would say that the SDRs are already anticipated, already built into the pricing at this moment. But also maybe the other way to look at it is so it's like I've just said, it's not so much about the availability of currency. It's how it's distributed, it's how it is allocated. And as you can just see, when the indications are such that when these funds are being applied, they will not impact the average man on the street. You and I, or most of the people, they don't get their money from the foreign, from the auction system. They have to get it from alternative channels like the power market, right? Power market. So you ask your question and say, okay, how much of that is going to filter into that area? So maybe that's you could have that sort of manage stability on the auction if those funds are going to be channeled there. But certainly on the power market, as long as there is no way that those funds which filter into that market, it's not going to change the dynamics. If anything, the rate could keep going up. Even at this with this windfall, and it just speaks to the level of confidence, especially the lack thereof in the market, about the capacity of the people or the policy makers being able to address the whole foreign currency problem that we have.
Okay, another development in the news is reporting that so far the GMB, notwithstanding the very attractive producer price that has been obtaining for most of the season, has actually seen less than 1 million tons of deliveries. And there are indications that millers are no longer getting their demand met by the GMB and are actually starting to lobby the government to be allowed to import maize. Whereas at the beginning of the season, the indication from official sources was that we had a fantastic harvest, that there would be no need to import any maize. In fact, we actually instituted a ban on the importation of maize. So what does this tell us? That do you anticipate that there's maybe another 500,000, a million tons out there that's still going to be delivered? And if not, what does this tell us? If we have to import maize, what does this tell us?
It's actually a sad outturn or development, because the indications were that we're going to have a harvest in the region of 2 to 2.5 million metric tons, and I think they were all necessary ingredients, sort of speaking to that, given the above normal rainfall season that we had last year. So, but I totally agree with you. We are already just a week or so into September, and if we only have got 900,000 metric tons delivered, I would not expect to have maybe another 500,000 metric tons coming maybe in the next few weeks. Ordinarily, you'd expect that most farmers by now should have delivered so that they get paid early. In fact, they pay these funds in Zim dollars, so I think there's actually an incentive for you to get an early payment, early delivery, early payment, so that you can plan your life and also maybe go back into the field and start preparing for the next season. So it's but it's probably it speaks to the way we assess these things. So maybe there was definitely an exaggeration if things don't turn out the way they expected, and maybe want to ask ourselves, what do we need to do better to try and um, um improve things going forward. And it's actually very sad because now there was that huge expectation that our import needs when it comes to grain were going to be zero. In fact, we're going to have an extra even to export. So if you start having a scenario where we may have to import even just a few hundred thousand tons of grains again, it will set us back in a big way, because that was not planned. And I think that harvest, that 2.8 metric ton, was a big driver to that adjustment in the growth in the agriculture sector from 11% to 34%. So if it turns out that maybe we won't have anything close to that, then it means that outturn is going to be, it has to be adjusted backwards. And it also is painting a very rather gloomy kind of economic projection for 2021 if we don't get the good outturn from agriculture. So if that importation is going to happen again, then it means some pressure on the currency again. And we might see part of those SDRs being earmarked towards paying for such things, and we may not get the full benefit from that.
And okay, the last issue is we've seen an extension of the lockdown. A few months ago we were cautiously optimistic that perhaps going into the second half of this year, the pandemic would be behind us, but it looks like we are unlucky. We've got this Delta variant that is highly contagious, and it's ravaging the world, and Zimbabwe is no exception. So what does this mean for, what does another 2 weeks lockdown mean in terms of our outlook for the second half of this year? And does the valuation of the ZSE, make sense at these levels, given that we've got another 2 weeks of lockdown, and we may be going in and out of lockdowns for the rest of the year?
Yeah. So, I obviously the lockdown was actually necessitated by the need to try and manage the outbreak further, and we were seeing quite huge numbers in terms of infections and deaths. So on that front, on the health and safety front, it's good that we take measures to try and preserve lives, isn't it? But it also then tells you that the performance of our businesses is going to be affected. I would say for this year it was just in Q1 where there was some semblance of sanity, semblance of stability. Q2 was probably marked by the onset of the third wave, and we're already getting into the end of Q3, with a possibility that even into Q4 we still have this thing. So I think generally this year I'm expecting much slower growth, if not negative growth for some of the businesses. Obviously, the base, it remains very low because 2020 was a very difficult year when we had a hard lockdown. But it just tells you, I don't think we are going to just have the next 2 weeks as the last bit of lockdown we're going to experience. I think this is going to be with us for some time, especially when you see what's happening in some countries that had made some huge strides in terms of containing the outbreak to a point where they sort of gotten back to their normal business. So it just tells you this thing will keep coming. Or I think we actually need to devise some plan of say, okay, how do we do our business on an ongoing basis, assuming that COVID will still be here, and every now and then we will see some spikes in terms of more people being affected. So I think 2021, Again, it will eat into that expected growth in the economy that we're talking about. So if, like I've just discussed, the output from agriculture is going to be much smaller than was anticipated, and now we have got most businesses volumes being affected by lockdowns. It just tells you that even that 7.8 growth rate that we were expecting is actually under threat as well. And it's going to be more pressure even on the SDRs, because now instead of focusing on production and productivity, it may have to be used or to be channeled towards even social areas. So the schools, at some point we need to have our children go back to school, and there is need for funding for that. And then the vulnerable in our society, as we have these lockdowns, they also need to get some kind of support. So those are some of the issues that we get, but you can't avoid the lockdown when your infection rates are actually going up.
So on that rather sad and pessimistic note, we come to the end of yet another show. Thank you so much for viewing. As always, we welcome your comments and suggestions. Please like us on Facebook and follow us on Twitter. Cheers.